Hello, everyone, and welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan, and today we're diving into some pressing topics that are shaping the real estate landscape in Ontario and across Canada. We've got a packed docket today, so let's jump right in. Our first story today is titled, Canadian Housing Outlook, When the Trickle Becomes a Flood. According to a recent report by TD Economics, the Canadian housing market is on the brink of significant changes. The Canadian 5-year bond yield has declined over 100 basis points since early May, and the Bank of Canada has cut its policy rate 3 times, with 2 more cuts likely on the horizon for this year. This means the interest rate environment has significantly improved, which is stirring housing market activity. However, despite the rush of rate relief, Canadian sales gains have been surprisingly subdued. The report attributes this to 2 main factors. First, the continued strained affordability backdrop. Even though rates have recently declined, they remain at levels last seen about 15 years ago. Second, the transparent messaging from central bankers that interest rates are set to fall even further is keeping potential buyers on the sidelines as they wait for additional cuts. The flat trend in Canadian average home prices since the summer means buyers haven't really been penalized for waiting. But this relative stillness is not expected to last long. Conditions are in place for a solid pickup in resale activity. Alongside a further steady decline in the Bank of Canada's overnight rate, economic growth is likely to regain some traction moving forward. The federal government is also rolling out meaningful changes to mortgage rules that will support home buying at the end of the year. For instance, first-time homebuyers and those purchasing new builds can now access 30-year amortizations instead of 25, which lowers their monthly mortgage obligations. Additionally, the cap on which a buyer can qualify for an insured mortgage has been raised from $1 million to $1.5 million. For example, a purchaser buying a detached home in Toronto valued at $1.2 million. The median price in August could now put down about $95,000 as a down payment instead of needing $240,000 as before. These federal measures should help unlock powerful gains in Canadian sales and average home prices across the country in the first half of 2025. However, part of this story is that some activity that would have taken place this year will be pushed into 2025, as buyers wait for the new rules to commence before purchasing. Regionally, these federal measures are likely to stimulate housing markets the most in British Columbia and Ontario, as these 2 provinces have the largest share of homes valued between $1 and $1.5 million. Average home price growth in these markets should also benefit from the strongest sales gains in the country moving forward, with pent-up demand driving a recovery in activity from low levels. That said, price growth will be restrained by loose supply and demand conditions in both regions in the near term and affordability backdrops that will remain historically challenging thereafter. In Ontario, we also anticipate some drag on average home prices coming from the Greater Toronto Area's oversupplied condo market. Meanwhile, price growth is expected to outperform in the prairies over the forecast horizon, lifted by tight markets, historically strong population growth, solid affordability conditions, and economic outperformance. Elsewhere, relatively tight supply and demand balances should keep prices on the rise in Quebec and the Atlantic provinces, although notable affordability deteriorations will prevent even stronger gains. Interprovincial migration has also begun to slow in the Atlantic, weighing on what is likely a key source of ownership demand in the region. When it comes to risks to this forecast, there's considerable uncertainty around the impact of the new federal policies. It could be the case that housing reacts more aggressively than what has been penciled in, especially in a falling rate environment. There are also many unknowns around how effective the federal government will be in slowing population growth. For instance, TD Economics thinks it could slacken to under 1% on an annual average basis in 2026, whereas the Bank of Canada's population projections embed a much stronger gain. On the downside, restrictive policy rates on both sides of the border could cause overall economic growth and job markets to be weaker than expected. The United States election is another wild card for both the United States and Canadian economies. Our next story focuses on a pressing issue in the realm of affordable housing in Ontario. Recently, the Residential Construction Council of Ontario, also known as RESCON, has made an urgent appeal to all levels of government to take immediate steps to reduce costs and speed up the processes involved in home construction. The Council is urging federal, provincial, and municipal authorities to lower taxes, fees, levies, and development charges, which they say are making it increasingly difficult to build affordable homes. During a recent meeting with Ontario Municipal Affairs and Housing Minister Paul Calandra, Richard Lyle, the president of RESCON, emphasized the critical challenges facing the home building industry. He pointed out that the rising costs are putting home ownership out of reach for many, especially first-time buyers. Lyle expressed appreciation for the actions taken so far by Minister Calandra and the provincial government, such as eliminating the harmonized sales tax on new purpose-built rentals. However, he stressed that the industry continues to face a perfect storm of high taxes and endless bureaucracy, particularly at the municipal level of government. According to Lyle, the approval process for new housing developments remains slow and dysfunctional, which is stifling the housing market, especially for first-time buyers. He described the current situation as a devastating housing affordability and supply crisis, and called for immediate improvements. We are still in the dark ages across many municipalities when it comes to residential development approvals. We can and must do better, he added. During the meeting, RESCON officials highlighted the financial strain on the home building sector, noting that new home sales are sluggish and construction starts for 2025 are looking bleak. They pointed out that high taxes and fees, along with bureaucratic delays, are making it increasingly difficult to build homes at prices that many Ontarians can afford. One striking example presented by RESCON was the contrast in development charges between municipalities. In Vaughan, development charges on a new home are $192,000, while in Calgary, they are just $22,000. Richard Lyle did not mince words when he talked about the federal taxes and municipal development charges. Federal taxes are too high, and municipal development charges are like a runaway train, he said. Costs to consumers for new housing are too high, and most first-time buyers and renters cannot afford the cost. A recent report from the Canadian Centre for Economic Analysis found that 31% of the cost of a new home in the Greater Toronto Area is due to taxes, fees, and levies, with the federal government responsible for the largest portion. In Toronto alone, development charges on single-family homes have skyrocketed by nearly 2,000% over the past 2 decades. RESCON argues that the situation is urgent, as the construction of new homes is failing to keep up with Ontario's growing population. On top of financial barriers, regulatory issues such as municipalities implementing green building standards beyond what the Ontario Building Code prescribes are further complicating the situation. Lyle also criticized municipalities for using development charges as a cash cow to fund infrastructure projects, noting that a large portion of these levies are sitting in reserve funds rather than being spent. While municipalities rely on the levies, a big chunk is not being spent. Instead, it is going into reserve funds, Lyle noted. The levies must be reduced to a more manageable level so the savings can be passed on to homebuyers. Immediate action is needed to lower taxes and fees, speed up the approvals process, and create conditions conducive to building homes. Ontario's Financial Services Regulatory Authority, or FSRA, has released its Mortgage Brokering Supervision Plan for 2024-2025, emphasizing its focus on consumer protection within the mortgage brokering sector. The plan underscores FSRA's enhanced oversight of private mortgages, given their growing market share and the increasing number of consumers turning to them amid challenging economic conditions. According to the FSRA, private lenders increased their market share of total mortgages to 20.4% by volume and 15.6% by value in 2023. This is up from 16.6% and 12.1% respectively in 2022. As economic conditions remain uncertain, it's critical for mortgage professionals to understand their responsibilities, said Antoinette Lung, head of financial institutions and mortgage brokerage conduct at FSRA. Our plan maintains our priorities from last year to ensure the mortgage sector is following the rules, giving sound advice to consumers, and safely handling their investments. The FSRA's plan focuses on 3 key areas. First, ensuring that brokerages and principal brokers foster a strong culture of compliance and fair treatment of consumers. Second, providing consumers with suitable mortgage advice and products, especially concerning private mortgages, which have become more prevalent. Third, ensuring that investors and lenders have confidence in mortgage administrators handling their investments properly. A central concern for FSRA is the increasing reliance on private mortgages, especially for consumers who face higher costs and complexity with these products. The regulator is closely monitoring mortgage brokers and administrators to ensure they are providing appropriate advice and disclosing conflicts of interest. FSRA also conducted exams of large brokerages, particularly those involved in private mortgage brokering and mortgage investment corporations, also known as MICs. These exams assessed the effectiveness of compliance controls and the supervision of authorized agents. FSRA examined brokerages responsible for funding approximately $850.6 million in private mortgages, which represented about 3.3% of all private mortgage fundings in Ontario. The report also highlights the risks associated with mortgage investment sales and administration, particularly as rising interest rates make mortgage investments attractive to more Ontario investors. The financial watchdog is reviewing how private mortgage investments are sold and managed to protect consumers, especially those facing heightened risks due to high construction and financing costs in the current economic climate. We urge mortgage professionals to closely read the plan and all relevant guidance and publications to stay informed about their regulatory responsibilities, FSRA said. Homeowners will no longer need to undergo a stress test when switching mortgage providers. This change comes from the Office of the Superintendent of Financial Institutions, also known as OSFI. The national banking regulator has decided to end the policy that required lenders to apply the minimum qualifying rate to straight switches when uninsured mortgages are renewed at a different institution under the borrower's current amortization schedule and loan amount. According to OSFI, the decision aims to correct the imbalance between insured and uninsured borrowers at the time of mortgage renewal. Industry feedback and data showing that the risks the requirement was intended to address have not significantly materialized led to this policy change. In March, Canada's Competition Bureau recommended that uninsured mortgage borrowers be allowed to switch between banks without undergoing a stress test. The Bureau argued that the policy was not applied evenly, and indeed, many in the industry and among the public agreed. The stress test, designed to ensure borrowers can still make mortgage payments in the face of financial shocks, such as an increase in interest rates or household expenses, was seen as a hurdle that disproportionately affected uninsured borrowers. OSFI is now working closely with financial institutions to ensure they are prepared for this change. The regulator intends to formally communicate this policy update as part of its next quarterly release on November 21st. This move is part of a broader effort by Canadian authorities to address the ongoing housing crisis. By relaxing some of the stringent mortgage rules, the government hopes to make it easier for homeowners to manage their mortgage obligations and, in turn, stimulate more activity in the housing market. Our final story today is about an exciting development in the mortgage market. Lenders are having a sale on fixed mortgage rates, and the deals get even better if you negotiate. This week marked fresh two-year lows for multiple nationally advertised rates. Among them, the 3-year fixed, insured, fell 20 basis points to 4.24%. The 3-year fixed, uninsured, decreased 10 basis points to 4.64%, and the 5-year fixed, uninsured, dropped 10 basis points to 4.54%. Well-qualified borrowers in some provinces can land even sweeter deals through regional players, as well as by playing big banks against each other. In some cases, banks are selling for 20 to 40 basis points below the rates they are advertising. Those 3-year rates mentioned earlier are still your best fixed mortgage values, assuming you do not want to gamble on a floating rate, and you need a mortgage for at least 3 years. 3-year mortgages are especially enticing if you get a great deal from a lender offering cash rebates. In that case, the projected effective borrowing cost of a shorter 36-month term can easily outshine all other fixed-rate options. Meanwhile, for folks who can stomach the chance that inflation rebounds and takes rates higher, variable rates remain the best bet on paper. That is assuming interest rates go where bond traders think they will go. It would only take a string of unexpectedly inflationary economic reports to wildly change what bond traders think. In summary, the current environment offers a unique opportunity for homebuyers and those looking to refinance to secure attractive fixed mortgage rates. Given the potential for further negotiations to bring rates even lower, it is a good time to explore your options and perhaps even play lenders against each other to get the best deal possible. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found today's insights valuable and informative. Stay tuned for our next episode where we will continue to bring you the latest developments in the Ontario real estate market. Until then, this is Steve Hamoin signing off. Have a great day.